CNBC-TV18 Motilal Oswal Studios in Mumbai.
Good morning. We're coming out of a weekend. It's a Monday morning. You're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you live from the CNBC-TV18 Motilal Oswal Studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi. Good morning.
Hi. Good morning. Good morning, Nigel. Well, it's a hectic week. A lot of queues coming through, but it's also a really truncated week. So we have only 3 working days. But lots to pack in that time. There's the RBI policy as well. Then we head into earnings season. So I guess we got our work cut out for ourselves, but lesser number of working hours.
Yeah, I mean, Monday's a holiday, and then Friday's a holiday. So
Tuesday's a holiday.
Tuesday's a holiday, sorry. Yes, Tuesday. Friday's a holiday. But, you know, there's always something, right? I mean, this morning, there's oil to talk about. Yeah. That is a new thing. So let's start with that, because I think as we begin a new trading week, a truncated one nevertheless, I think the big cue is that oil prices have jumped about $5 a barrel. Now, who would have thought? Suddenly, out of the blue, Sunday night, OPEC Plus surprised the markets with a big output cut. I mean, actually, it is big. It totals about 1.6 million barrels per day. And they're taking a lot of oil out of the market, just as expectations are that demand should perhaps be steady, if not pick up a little bit, with China fully coming into the market in 2023. So, you know, it's a bit of a shock reaction as far as oil markets are concerned. We got brokerages like Goldman Sachs, etc., saying that this basically means that their average price, oil price for, I think, second half of this year moves up to about $95 a barrel. It does provide this comfort to at least oil suppliers that they'll be able to extract higher prices even if the world goes into a bit of a slowdown. The implication is very simple. You know, inflation has been coming off in the U.S. Inflation has been the big problem all the way from late 2021. 22 was a problem. 23 is expected to remain a problem. And things like this affect inflation across the board, developed markets, emerging markets, etc. So inflationary impulses due to the jump in this 5% jump, I think we need to wait and watch. The unknowables at this stage is, will it stay contained at a $5 jump, or will it become more? And how long will the strength last? Which I think at this point in time, we don't know. But this is important, especially for a big oil importer like India. This news item, I think, will be closely watched. Otherwise, I mean, you know, had it not been for this, global sentiment continued to improve. And we were making this point all of last week as well. On Friday, the Nasdaq ended about 1.7% higher. The S&P 500 was up. You know, so I was saying this on Friday morning and Thursday morning as well. Around the time when, markets get visibility that we are going to see the last of Fed rate hikes, yields collapse. Usually, typically going back in history, nominal and real yields come off sharply. That is very positive for technology, startups, companies where they don't make money now but will make money into the future, new age, digital companies, etc. as well. So keep an eye out on that space. The 10-year lost about 8 basis points on Friday, the US 10-year. Otherwise, also, data from Friday, this is the Fed's balance sheet, shows that deposit rotation from small to large U.S. banks is stalling, which is very good news. The concern was that smaller regional banks will continue to be in trouble and people will prefer to keep their deposits in larger banks, triggering a bit of a crisis. That is also stalled. This is data, mind you, for the week ended March 22nd, but the data came out last Friday. Okay, let's just come to the market here. Nifty is broken out from the congestion zone. We had a nice rally. We started 100 points higher on Friday and added 150 on top of that by close. We closed above the 20-day moving average on the Nifty as well. We've also seen positive weekly and monthly closes. Technically, this is significant. In the near term, the 40-day exponential moving average comes into play. That stands at about 17,406. So we closed at 17,359, very near term. It's another 60-odd points. That's a 40-day exponential moving average. The upper end of the medium-term channel now stands, the downward sloping channel, now stands at 17,630. It is slightly some distance away, some 300 points from where, less than 300 points from where we closed on Friday. But these are near-term levels, 17,406 and then 17,630. Banks lately have been doing even better than the Nifty, at least in the short term. So on the Bank Nifty, the gap formed on the 10th of March, and this is the range which is perhaps likely to act as a very near-term resistance zone. 4839 and 41208 will act as the first resistance zone, and the medium-term resistance for the Bank Nifty stands at 41,400. again, I mean, this is a couple of percentage points, but that's what you need to watch if you're looking at the market on a day-to-day, very near-term basis. You got to also keep in mind this is a holiday shortened week. Tomorrow is a holiday. And then you got one more holiday. A lot of activity will be absent. People away taking a quick break with sort of these holidays helping. So watch out for liquidity. Watch out for these holiday-led interruptions as well, which are technical in nature but become important considerations if you are trading. SGX this morning is indicating a flat start, about 30-odd points or so. Sonia.
Oh, absolutely. And, we would be building on to our gains of last week, right? I mean, the Nifty did quite well last week. It was up almost 2.5%. The Nifty was one of the best performing markets compared to its peers last week. And now, today, we'll just be building on to our gains. There are a lot of positives that this market could latch on to. The domestic cues are also looking good. In fact, the auto sales, which is a key barometer of sentiment in the economy, has seen a bit of a pickup, especially the likes of Maruti, Hero Motocorp, the auto guys that are exposed to the rural markets. Not bad. Hero Moto saw 15% sales growth. Maruti, in fact, in FY23 has recorded its highest ever annual sales. And the management is quite bullish as well. So domestic cues are sort of stabilizing and picking up, especially the weak pockets. For the US markets as well, we've told you how it was a pretty strong run that we saw on Friday. And the Japanese market, as we speak, is up over 170 points as well, so looking pretty good. But there's lots of data to watch out for. Of course, one eye will be on crude after the surprise OPEC cut and the way crude has moved. But this week, there's a lot of data to watch. So there's the job opening data that happens on Tuesday. There's the ADP private payrolls on Wednesday and the monthly jobs report on Friday. All of these data points will be imperative to gauge which way the market heads from here. There's also the RBI meeting on the 6th of April. There'll be a 25 basis points rate hike that the street is penciling in. So that's something that we're going to focus on as well. You have earnings season that begins on the 13th, with Infosys coming out with numbers on the 13th. And this is important because Infosys will be the first company to give out a full year guidance for FY24. So we'll kind of, gauge which way things are headed from the tech companies. Then there's ICICI Bank on 22nd as well. So all in all, you'd have to say that after a smooth run that the market had last week, perhaps we could build on to our gains today. But let's see, this level has been a bit of a hurdle for the market on the upside. Yeah. Let's see if there are enough and more triggers to take this level out.
Well, the big question is, Sonia, whether or not this is a relief rally or are things turning around and have the markets decided that they want to move up from here? Well, we'll know that in the coming month itself. The FI as well, they're yet to cover short positions though, so they continue to remain aggressively net short on the index, which, as we've been saying the last few sessions, that's not such a bad thing. FI is net short. If he could hold or move higher, they'll be forced to cover up. But more than the headline index, I'll be watching the broader markets, and I'll tell you why. Because April has historically been a very, very good month for the broader markets. And the last 10 years of put out data, the mid-cap index has outperformed the Nifty on an average. I'll give you another data point. For all of those 10 years, barring 2019, the mid-cap index did better than the Nifty. So that's another data point. Even last year, that's 2022, the Nifty was down 2% in the month of April, but you had the mid-cap index that was up close to around 0.5%. So can this continue? Well, that's going to be very, very important because the broader markets have really got hammered and there'll be fresh allocation that will come about because it's a new fiscal. So that's an important data point besides the headline index. But getting back to the headline index then, the Nifty and the Nifty Bank, they did well in Friday's trading session and there was clearly about a short covering as the open interest was lower. What did the FIs do? They didn't cover shorts as yet, but they added some long positions. 4,000 long contracts is what they added. Shorts continue at around close to around 89% of their positions. So the hope is that they were forced to cover out at some point of time. On the options front, well, they're buying more puts than calls. So in case things go wrong, well, there is some protection on the downside. But what's heartening to see is that they wrote way more puts than calls. What were they writing? Well, you have a couple of strikes, 17,300, 17,200 put. Between them, more than a crore shares were added out there. So there was writing being seen and a bit of a punt being taken at around the 17,600 call because big open interest built up and maximum you lose around 15 rupees or thereabouts, which brings us to the level. Since we are seeing writing at around 17,300 and 17,200 put, well, the 17,150 to around 17,200 becomes very important, which is bang in line with around the 20 DMA. On the upside, the 200 DMA will be a bit of a resistance. So 17,500 is what we're looking on the upside. For the Nifty Bank, we saw some writing at around the 40,500 put. So the 40,200 becomes very, very important as a support level. And on the upside, only around 150 points away from here, the 50 DMA. So that becomes a bit of a resistance. SGX 50 suggesting a bit of a green opening, maybe 20-25 points higher. But what happens from there is important. And yet again, guys, I'm going to be tracking the broader markets because, as I said, history suggests that April is a good month for the broader markets. So, portfolios will be hoping that they can repeat it this time around as well.
Absolutely, and history does rhyme, right? So let's hope it rhymes.
It doesn't always repeat, though.
Repeat rhymes.
But 9 out of 10 times it's happened last.
So it's likely to be a decent one. Well, before we go any further, let me quickly tell you what's lined up in the first half hour of the show today. We'll get you updates from markets across the globe. Ed Yardeni of Yardeni Research will join in to discuss the global trade setup. Our research team will join in for the top list of stocks to watch. Our research team will get you that. And 8:30, we'll dissect the markets with Prakash Diwan and understand from him the stocks he's got his eye on as well.
All right, let's do one thing. Let's kickstart the show now with a view coming in first up from one of the brightest minds in the business, Chetan Seth of Nomura, who says that in Q1, the US data has been fairly resilient and US inflation has been moderating. Recent banking sector concerns have quickly eased given aggressive and decisive actions from the authorities. While the Fed is likely done with its hiking cycle, as long as these conditions persist, we think stocks are likely to be well behaved.
Let's get you some money market views as well. On the rupee, B. Prasanna of ICICI Bank says the dollar eased as risk sentiment improved with moderation of banking crisis risk in the US and Europe. He says rupee outlook remains positive with improvement in the current account gap. He expects the dollar INR pair to take cues from the RBI MPC decision this week and trade between 81.8 to 82.8 to a dollar.
And on the bonds, V. Prasanna of ICICI Bank says global yields hardened initially in response to easing contagion risk but fell later due to lower inflation print and softer economic data. Local bonds remained under pressure as resumption of supply and upcoming MPC meeting kept participants in risk reduction mode. He expects yields to remain range-bound going into the RBI policy, where the odds seem to be even between a hawkish pause and a dovish hike. Prasanna expects the 10-year benchmark to trade in a range of 7.2 to 7.45%.
Okay, well, Ed Yardeni is now joining us. He's president at Yardeni Research. Ed, good to have you with us here. Thank you very much for your time. So the new thing this morning is the big jump we are seeing in oil prices, which affects everyone around the world. How big an inflationary impulse is this likely to prove for policymakers, in your opinion?
Well, I think initially we're all just going to have to sit back and see how the market settles out. I mean, clearly it was a big surprise, and there were some shorts that had to cover. But I think it's possible that one of the reasons the Saudis have announced a cut is because they recognize that the global economy may not be as strong as widely anticipated. The Chinese economy has picked up since the end of its lockdowns, but it hasn't been a real gangbusters boom over in China. And meanwhile, the U.S. has this banking crisis, which is bound to slow economic growth. I don't think it's going to cause a recession. But I think in many ways, the Saudis took a preemptive, preventative approach here, fearing that the price of oil would continue to decline.
Ed, hi, good morning, and thanks for being with us on the channel. How do you see the equity markets globally evolve from here? One narrative is that the worst of the crisis, the recession, the rate hikes have already been priced into global markets, including market like India. Would you concur with that view?
Well, I think that once again, the Federal Reserve is turning out to be the key player here that affects everybody else playing the game. The Fed is likely to perhaps go up by another quarter point. I think they should be done, actually, because I think we are continuing to see inflation moderate. And meanwhile, the inverted yield curve has been predicting since last summer that if the Fed continues to tighten, something might break in the financial system. And sure enough, we have a banking crisis. I don't think it's anywhere near the banking crisis we had in 2008. But nonetheless, it is a crisis, and banks are going to slow their lending. The economy is going to slow. And I think inflation is going to continue to moderate. So I think the global economy, focusing on the Fed, probably recognizes all that. And I should say the global financial markets recognize all that. And as you mentioned before, the lower interest rates are very beneficial to technology stocks as long as it doesn't signal that we're going to fall into recession. I'm in the soft landing camp. I'm in the camp that argues that we've been in a rolling recession rather than an economy-wide recession.
Hi, Mr. Yadni. Good morning. We've been talking about QT and a lot of worries out there, but a first sniff of trouble with regard to these banks. And the Fed's balance sheet is indicating QE yet again, the updated number that they've put out. Do you expect more of the same, or do you think that it's temporary?
Well, it's all pretty confusing, right? Here they're still got QT going on. They're still letting maturing securities off their balance sheet. They're not buying new ones. But at the same time, their provision of liquidity to the banking system has been quite substantial just in the past 2 weeks. And that means that their total assets have actually increased, even though they're still committed to QT. So we've got this very strange combination of QE on the liquidity bank crisis side and QT on the long-term effects of trying to manage some backing away from all the excessive QEs of the past few years. I think on balance, we have to just focus on what the outlook is for the federal funds rate. And I think what the market has come to realize is that we're at restrictive. We're probably very close to terminal, if not actually there. And that's why we've seen bond yields come down and the 2-year yield come down. And that's beneficial for the stock market.
The other big problem that the US economy is facing is layoffs, right? I mean, I was just looking at the data. In the first quarter of this calendar year, 136,000 people have been laid off. That has already exceeded the layoffs in the last 6 months of 2022. And the fear is that with these layoffs, employees losing their jobs, higher inflation could pinch further, a multiple round of rate hikes could throw the economy further into recession. Have you priced that into your argument about how weak the markets could get, or is that an additional fear that could perhaps, derail the markets further?
You make a good point, because we always get very low unemployment rates right before bear markets in stocks. Well, we've already had a bear market last year. I think it ended on October 12th. But we could have another downdraft in the market if there's a perception that we're losing the consumer because consumers are losing jobs. The labor market is another example of all the confusion that has occurred as a result of the. And I think in this case, what we have a lot of layoffs, particularly in technology companies that hired too many people, and now they're cutting back. But a lot of those people are very skilled, very educated, and are probably going to be finding a job isn't that hard. By the way, a lot of them also got severance pay, which is maybe why we haven't seen initial unemployment claims going up. But the other thing that's going on is people like myself, baby boomers, a lot of my friends are retiring. And you know what they do in their retirement? They spend money. They go to restaurants. And so the demand for employees in restaurants has been soaring. And they go to the hospitals just to make sure they're okay. And as a result of that, there's a tremendous demand for healthcare workers and restaurant workers.
Ed, we leave it there. Thank you very much. Great speaking with you, and catch up with you soon again. Thanks indeed. Ed Yardeni Research with a quick thought. Basically, I mean, we need to wait and watch for the oil markets to settle. How it's not 5% is a meaningful bounce, but will it go any further, and how long will it stay this high for? Are the two questions which I think markets will watch closely. We'll take a quick break here. Our list of top stocks to watch with our research team coming up in just a bit from now.
Welcome back. Hope you're having a good morning so far. We definitely are, because it is, the SGX Nifty is suggesting that we'll have a green start today, and it's a truncated week. One of those rare weeks where we have only 3 working days, so we're making the most of that. But let's get talking about one of the big headlines globally, which is the way Brent crude has moved. In a flash of a pan, Brent crude is now back at $85 a barrel. So a big move is what we saw, about a 6% move. Look at that right now on Brent. We'll tell you the reasons for that. Manisha Gupta is here to give us, an outline on what all happened in the last 48 hours. Manisha, over to you.
Oh, well, absolutely. All of that happened yesterday on a Sunday for us. And, the movement today hasn't come in as a surprise. And we opened Asia 7% up on crude oil prices. It's 5.5% on the higher side right now, reacting to the surprise production cut from OPEC and allies of around 1.16 million barrels per day. Almost everybody, 100% bet was that OPEC and allies will not do anything. So this is definitely a surprise. And we have seen prices gain up from a 15-month lows of $70 a barrel to 85 on your screens right now. It is trading at a 1-month highs too. So the total volume cuts on what you see from OPEC is at 3.6 million barrels per day, which is 3.7% of the global demand. So that's a big number coming in from there. In the last couple of weeks, in any case, we have been dealing with China demand rebounding. 400,000 barrels per day of exports from Turkey also are halted because of legal disputes there. So there are supply concerns now coming into the market. And with the U.S. inflation also slowing, that tells you that perhaps U.S. will not be as aggressive with rate hikes. So almost everything seems to be supporting the crude oil prices right now. And Goldman Sachs, immediately after the OPEC and allies announcement, has come out with a new forecast where they are suggesting that the crude prices will average $95 a barrel in this year and $100 a barrel of an average in the next year. So that does give you a big range and huge volatility and much more bullishness from here in prices.
All right, Manisha, thanks very much for that. Do note we will connect with David Lennox of Fat Profits in a short while to discuss the big jump that we've seen in oil prices. Well, that's coming up in a bit from now. But here and now, let's focus on the big story, which is going to also be auto sales numbers. Sonia, I think two-wheelers have shown some strength, right?
Overall, the numbers were not too bad.
Yeah.
We were expecting worse. And given that there is a slowdown underway in the rural market, etc., it was not a bad showing. So I'll tell you why. For Maruti, the March sales were much better than what Nomura was expecting. Even for the full year, right, Maruti recorded its highest ever annual sales and highest ever annual exports in FY23. Total annual sales exceeded 19.5 lakh units. The total March sales, though, were flat, but not bad given what we've seen. We were actually expecting a fall this time around at 1.70 lakh units. Hero MotoCorp as well, sales were better than what the street was expecting at 5.19 lakh units. Nomura's estimate was 4.9, and it's a sales growth of 15.5% on a year-on-year basis. Eicher Motor as well, the Volvo Eicher commercial vehicle sales were not bad at all, 35% growth. Yes, there was a slowdown in Royal Enfield sales, just a 7% growth is what we saw, but I think that was something that the street was expecting, given that there is, inquiries have reduced in the premium end as well. For TVS Motor, the overall sales growth was in low single digit. It was dragged down by very weak exports. Exports were down 46%, so I'm going with red over there for TVS Motor. And for Tata Motors, you had a total sales growth of 1.7% at 90,867 units. Commercial vehicles were under pressure. Passenger vehicles were up just 4%. That's peculiar for Tata Motors. So the growth is definitely slowing down. So I'm going with red over there.
All right, Sonia, I'm tracking two companies which have come out with their updates. And yes, a cement company and the largest one here in India, Ultratech Cement, they have come out with their cement update, the sales operational performance for the first time ever. And if they come out with an update, boy, it had to be good. And it is very, very good. So the grey cement sales in India for a single quarter has clocked closer around 30 million tons. That's the normal cement. Besides that, if you club in the white cement, then they've given their numbers as well. So grey cement sales are up close to around 15%. The industry is likely to have grown by around 10 to around 12%. So Ultratech Cement for the past quarter, they have outgrown the industry, so they've gained some market share as well. And for the past year, they've clocked 100 million tons. Remember, this is only grey cement volumes, so that gets a thumbs up as well. For the quarter four, they were functioning at close to 95% or thereabouts. A rough analysis suggests. So that one opens up in the green. And besides that, there's a price increase that's been pushed through. So, it'll react to that as well. APL Apollo Tubes, well, expecting green out there as well, because the largest player again in their space, they have done quite well. Total sales volumes up close to around 18% odd. It's the highest ever quarterly sales number that they've reported. And because of the new Raipur unit, which is scaled up and capacity utilization is around 28%, that's what's giving them a thumbs up. For the year, they've clocked close to around 2.28 million tons. So green on both those two stocks. But defense stocks continue to remain in focus. Vivek joins us to fill us in with that. Morning, Vivek.
Well, good morning. Quite a few different stocks will be on the radar on the back of FY23 updates that they've given, year-ending updates. First on our list is Bharat Electronics. Expect some green there. Now, the company's FY23 revenues have jumped up almost 15% on a year-on-year basis. Order book quite healthy at 60,500 crore, and FY23 order inflow came in at close to 20,200. Now, reacting to these numbers, Antique says that the revenue growth as well as order inflow are both in line with what the management had guided for earlier. HAL, Hindustan Aeronautics, FY23 revenues have jumped up almost 8% on a year-on-year basis on a strong base. Order book is at 82,000 crores, and FY23 order inflow has come in at close to 26,000 crore. What Antique says is that, the revenue booking is largely in line with what they were anticipated. However, the order inflow has come in below estimates on the back of lumpy bookings that the company is actually witnessing. Also keep an eye out for Garden Reach Shipbuilders. FY23 revenues up almost 45%, coming close to the 2,550 crore range. BHEL, some positive news flow coming in there. The company has received a letter of intent for supply of strategic equipment for the defense forces. Order size of close to 3,700 crore. The time period is quite long. It's spread out over the next 12 years.
Okay, thanks a lot for that. So lots coming through in the defense space. It refuses to move out of the news. But let's go across to Abhishek. He's tracking CSB Bank. There is an update there as well. Abhishek, how is it looking?
Well, the operational business update is very strong for CSB Bank. It continues for second quarter in a row. The deposits are up 21.5% YOY and more than 8% sequentially. The CASA growth has been phenomenal given the fact that CASA ratio has improved on a sequential basis as well. Loan growth pretty robust at 30.3% YOY and about 11.75% quarter on quarter. Calculation shows that the CD ratio, or credit to deposit ratio, has improved by 275 basis points on a sequential basis. So they have been able to command on yields as the CD ratio has improved. It also suggests that net interest margin may remain healthy. Gold loan portfolio that's grown robustly by 48% YOY and about 10.5% sequentially. However, the share has declined by about 50 basis points quarter on quarter, given the fact that non-gold portfolio growth has been pretty robust at about 12.9% quarter on quarter. Back to you.
All right. Thanks a lot, Abhishek, for that. Well, here's a quick recap of our top stocks with positive news flow. There's ONGC, Eicher Motors, Maruti, Hero Motocorp, Escorts, Kubota, Ultratech Cement, APL Apollo Tubes, defense stocks and CSB Bank. While the only stock with negative news today is Tata Motors on the back of subdued low single-digit growth that we've seen for some of their key segments. We'll slip into a quick break. On the other side of the break, Prakash Diwan will join in for some fundamental stock analysis. We'll also talk about the big headline, which is the move in crude. David Lennox of Fat Profits will discuss the big jump.
Welcome back. Hope you're having a good morning. Well, auto sales numbers continue to come in. Ashok Leyland's numbers, they look quite good actually, because the MHCV sales have jumped up by close to around 20%. And also the numbers a little better than the brokerage note that we put out. So the total sales numbers have grown by close to around 19%. And I think we had an estimate of close to around 22,000. Now it's coming closer to around 24,000. So now these numbers look pretty good.
Oh, they do actually much better than what the street was estimating. I'm just trying to get a sense of what the numbers were, what the trajectory was. And if you look at it, what the management had told us as well, currently their market share is also growing. They're sitting at almost 32% market share overall. And they said that not only are the numbers growing, but the market share compared to the overall market. If you compare it to what Tata Motors just did in the CV space, I was just mentioning how Tata Motors numbers have actually fallen in the commercial vehicle space. So in that context, Ashok Leyland is doing quite well. Over the last 6 months, the company said in the last interaction I had with them that they've gained 6% market share. So it would be very interesting to, find out from them what the tally has been in the month of March itself. Also, another thing is they are looking at double-digit volume growth in FY24. So that was the guidance that they had put out last time around. But Prakash Diwan is joining in. So let's get a quick call from him. Prakash, Ashok Leyland has been one of the strongest stocks. At 140 though, is the risk reward still favorable for a long-term investor based on these numbers?
Good morning, Sonia. So, I think essentially if you see Ashok Leyland has been very sideways on the stock at least. But from a business standpoint, this was a year of transition for them. This was a year of consolidation. If you see the portfolio mix, the product mix itself, their focus has been on the MHCV, this thing, very clearly, given the fact that that's the segment where the margins are far more superior and the growth, the volume growth is also very promising. And that's what even the Tata Motors numbers actually tell you, while they might have lost in the context of market share. So essentially, when you have a market, when you have an economy where it's the old economy sectors that are doing well, there is no reason why commercial vehicles will not start participating with a lag. So I think given the kind of movement that you see on commodities, especially coal and steel and all, and the way the GST numbers tell you that, there's much more that's happened in terms of improvement in terms of, mobility of commercial goods and commodities, there is going to be a very, very significant tailwinds to this particular business of the commercial side. Commercial vehicles is also another area where the impact of raw material price hikes was very high throughout FY23, and that might not be the case going forward. So, a lot of things kind of falling in place for them. I think at 140, it definitely offers you at least a 15-18% kind of an upside. And it's done well. I mean, it's done, 10%, 12% for the whole year, for the whole financial year, which is really not bad given the fact that most of the nifty, metrics are not as robust.
All right. Hi, Prakash. Good morning. Prakash, we normally don't see any cement operational update coming in from a big cement maker. But Ultratech Cement, they've turned that around this time around for the first time, I think, in the last 10 years that I'm tracking, more than 10 years, have they come out with an operational update. And boy, isn't it good. How do you read that? Because they've grown by 15% in Q4 on a year-on-year basis. The industry could have grown by around 10 to around 12%. So how do you, how do you look at Ultratech Cement from year on? It's done very, very well. They're gaining market share. And now there's a price increase that's been pushed through for the entire industry on the whole.
Yeah. So absolutely, Nigel. I think this is a very clear indication of the industry coming of age. There was a time when we used to get dealer updates with a little bit of a lag, and then the quarterly updates, which also used to be at least about 20 days into the next month. Here, you're talking about businesses doing so well and system being so robust. And Ultratech will have to innovate and not just innovate, reinvent itself, at least on the distribution side, given the fact that it's building such huge capacities. And that's exactly what's kind of helping them grow these volumes. They don't get restricted with geographical concentration anymore. I mean, they're so evenly balanced. I know of this thing that the fact that they're actually looking at recruiting more dealers after a fairly long time, which hasn't happened in the industry for quite some years. And that tells you that they've started flexing their muscle on the distribution side in anticipation of all the capacity increments that they're looking at. Importantly, grey cement is a core business, which means if this is the number that Ultratech has been able to clock, maybe some of the other players might be around that, if not at 15%. But, anything upwards of 11, 12 is very positive for the entire sector. So I think the sector will start seeing a little bit of interest come back in this financial year. And we know housing and all is looking so positive as well. So great headwinds, good metrics, raw material benign, everything, raw material prices being benign. I think it really works well for the sector.
Prakash, and just to update our viewers, that later today we'll be having the management of Orient Cement. They have given us their view in terms of how cement demand is shaping up, pricing, as well as how they see things shaping up ahead of an election year. So, at around 2 p.m. today, just thought I'll plug that in as well.
Absolutely. Prakash, your thoughts on the big jump we're seeing in oil prices and the impact on, a multitude of companies, right? We're seeing a 5-6% jump. Any actionables straight away?
So I think, Prashant, this is something which might not go down very easily and might puncture this whole momentum that we've seen last week build up in our markets. Though the US handover seems positive, but I think this crude the decision on the production cuts have come past that Friday, and that means that we will see some negative reactions. We could see a little bit of tepidness in the market and across sectors. This is not something which is going to, because it's going to impact inflation, which is the big issue that everybody is trying to get a handle on. And if that is going to be let loose, then again you have second order, third order impact on most sectors. So I think this is going to be a week where you'll probably see a little bit of weakness. And if you were to look at specific areas that start looking promising, you have the likes of Reliance, you have the likes of ONGC. I mean, they are the ones who have benefited always from a more secular trend point. And you have some secondary pockets like the ethanol players, the ethanol production, ethanol equipment manufacturers. So that's another theme that you could probably see start galvanizing.
Okay. Prakash, I have many more questions for you, largely on auto stocks, as you would expect. But I need to take a little bit of a breather and talk about the other big headlines. So just wait by for a bit. Crude prices have rallied 5% now, trending at above $84 a barrel after the OPEC plus oil producers announced a surprise production cut of 1.16 million barrels a day. David Lennox, the analyst at Fat Profits, joins us now to talk about that. David, good morning. Even despite that, sudden spike up, Brent crude is still below $85 a barrel now. Do you get a sense that there is much more upside based on the news flow that has transpired in the last 24 hours?
Oh, good morning, Sonia. Yeah, no, one would have to suspect that, yes, we've seen the surprise lift in the oil price because of that news, and we probably at this point in time will see somewhat of a steadying up of the price going forward. Yes, the 1.15 million barrel cut that comes in May and will run through to the end of this year, certainly the markets weren't expecting that. Look, overall, what were OPEC looking to, or what were OPEC seeing that perhaps the rest of the market wasn't? We think that we've talked about this on numerous occasions. There is destruction of demand being forecast if we see a recession come through. The oil price certainly declined on that fear, and we are now seeing perhaps some remedial action being taken by OPEC to lift the oil prices higher. So we're not expecting to see the price to galvanise much higher from here. That surprise factor has hit the market quite quickly, and we've seen the result of that, as you've said, with Brent up at $85 odd.
Hi, David. Good morning. So for the year, given the kind of cues that we have with regard to demand, supply, and this recent cut, what is the broad range you'll be working with?
It certainly is going to be a broad range. It really is at this point in time probably difficult to sit down and say which direction the oil price will go. You'd have to back OPEC and say that they want it higher, so we would be suspecting that oil prices would move higher. We had called for a higher range, but we weren't convinced of that when we started to see the recessionary fears set in and the demand starting to perhaps get destroyed by that fear. So look, overall, we would expect to see Brent trading in the near term probably up at $85, probably not much above that. Going out into the longer term, if we do see this consistent Brent and WTI price, and it does start to feed back into global inflation, then that's really going to change the scenario again. That will lift the fear of inflation again, and we think towards the latter part of this year, if that fear is still in place, then demand will certainly be lower, and that will bring the oil prices down. So overall, we're looking at this point in time in the short term up to between $85 and $87, but perhaps longer term we could see the oil prices actually weaken, and we wouldn't be too surprised if we saw it between $70 and $80.
David, any political ramifications of any of this? There is the SPR in the US as well. So some are saying, well, this could be because they were not filling that up as fast as maybe the Saudis would have liked. Any thoughts at all?
Look, it's difficult to determine if there's any political scenario in what OPEC have done. We would suggest that the only benefit that they've gained is that they've probably knocked US shale production for 6, and they don't expect to see that production coming back on stream. Of course, as they raise prices, if they cut production further, that could change. But I think they're very comfortable that they now control the markets again. And probably from that perspective, that's really all that they were looking for. Yes, get control back out of the shale oil producers' hands. It's taken a couple of years for that to happen. We think that's probably the only political agenda. We're all well aware that the recession fears were growing, and we saw the oil price reacting to that. And OPEC have stepped in to try and reverse that fear.
Okay.
Sonia, if you remember, 3 weeks back, we had the beginnings of what looked like a positioning-driven tactical rally, which did not materialize because SVB happened and everything went haywire. Last Friday, we were making the point that maybe this is the beginning of, a little bit of a decent move, a relief rally, and there is room for that, right? And then we've got this oil price jump. Although this is not as significant as, because this is still in the infancy. The move is just 5% at one day, reacting overnight to all the action. So maybe it'll not last, but definitely it's a better situation as compared to banks going under and banks going bust in the US. But it does muddle the waters once again. It's not all clear.
I guess these are all imponderables, right? But David, thanks a lot for joining in and giving us a quick update. So that's on the crude market. But let's get back to the data that we have in our hand, which is the auto sales data. Prakash Diwan is still sitting by with us, so let's analyze some of it. Prakash, very interesting what's happened in the two-wheeler space this time around. So there was a capacity constraint that Honda Motors has faced, and that has actually helped boost the scooter and two-wheeler sales for both Hero and TVS. Hero, of course, comes off a low base as well, so there's a 15% growth there. But that doesn't mean that the worst is over, does it? And what would you do now with some of these stocks?
So Sonia, I do agree this could probably be a flash in the pan, given the circumstances that Hero MotoCorp has had to its advantage. We'll probably wait for the Bajaj Auto numbers to tell you whether exports is seeing any revival. Of course, that doesn't impact Hero any which way, but between TVS and Hero, if you see, I don't think there is too much of a demand change that's being indicated by these numbers, which is more longer term in terms of a trend. And I keep on believing that in India, the pickup in two-wheeler sales only comes in Q2 of the financial year after the monsoon has its own impact. So, those are things which will matter. And I have a feeling that you'll probably see a revival only towards the second and the third quarter of this year. So there's no hurry to buy into any of these two-wheelers. The commercial vehicle space is where you look at, and I told you why Ashok Leyland also has an advantage vis-a-vis Tata Motors and M&M. Both these companies are focusing on consolidating their PV portfolios, their EV portfolios. Ashok Leyland has a very clear monotask kind of an approach on commercial vehicles, and they'll do probably very well if the entire sector is kind of revving up. So that's it. And of course, Maruti has its own advantages. Wait for the Jimny pricing to be announced. That could probably be setting the cat amongst the pigeons on the passenger side. So a lot's happening, I think, in this particular quarter. And then we'll probably see a little bit of a shakeout in terms of what's the top, what are the top picks for most people. There could be a reshuffle in that deck for sure, I'm sure, in this 3 months that we are seeing.
All right, Prakash, stay with us. We'll take a quick commercial break here. There is about 14 minutes to go for the pre-open session. So we'll come back with that. And of course, we'll have our technical analysts join us on the other side to run us through what the picks are, trades are, F&O expert also. The Momentumizer segment will put the spotlight on a stock or two. At 9:10, Nimish will join in with the standout brokerage report of the day. And of course, stock boards will focus on the stocks which are likely to be in action on the back of news flow. Stay with us. Okay, welcome back. This is what just counting down to the pre-open session. 34 points on the ASX is what we have in terms of a start. Indicative start. Mitesh is with us and Srikanth is with us as well to run us through what they're making of the screen and what's their reading of the start and then what happens after that. Gentlemen, good morning. Good to have both of you here. Mitesh, very good close on Friday, very good handoff from the US. And then we got this jump in oil prices this morning, which I don't know how much will it be a spanner in the works. But what's your sense? What's the strategy? If we get a 30, 40 point higher start, what would you recommend?
Morning, Prashant. So I think on Wednesday, I think, we talked about the fact that we are seeing first signs of reversal. And we could possibly look at this time the market's trying to get past 17,250 and head towards 17,450, 500 zones. I think with that 30-point gap up, we might open very close towards 17,400 level. So on an immediate basis, I wouldn't be a buyer. I think wait for an intraday dip. The best idea is to possibly, look at buying closer to about 17,300 if you get it. Otherwise, if you don't have longs, then try to find stock-specific longs, which are, stocks which are giving reversals and are breaking above their intraday averages or their 10-day averages and showing good indicator setup. So I think that's the way we'll approach it. But broadly, I believe that 17,450, 500 would be the area where the Nifty will head towards and see significant profit booking. In case we start getting past that, there's an outside chance of us doing that. Then I think the rally could possibly extend to 17,750. But for the timing, we'll take the target as 17,450, 500, take profits over there. And in case we see strength beyond 17,500, take a fresh long.
Okay, all right. So watch out for that 17,450, 17,500 odd mark. Don't chase the opening. Look to buy on a dip. And if we break that mark, then maybe, in fact, we get to around 17,750. Thanks, Mitesh, for that. Shrikant's with us as well. Morning, Shrikant. How would you approach the indices today?
Good morning, Nigel. I think, see, the way the market has broken the level of 17,200, one thing is very clear that we are heading upward. But at the same time, we cannot forget that it's a pullback to the recent sell-off that we saw from the levels of 17,800. So we may see the levels of maybe 17,500, 550 in the near term, but the strategy should be to buy on dips around 17,250, 17,300. The market is having excellent support. Between these levels, we should be buyer in the market with a stop loss somewhere close to 17,200. And on the higher side, on immediate basis, as Mitesh said, I think we may see the levels of 17,400 or 450. For the Bank Nifty also, the important level is 40,800, 850. And in the best case scenario, we may see the levels of 41,250.
Okay, what about individual stocks? Let's get down to that. Mitesh, good morning. What's on your buy and sell list this morning?
Good morning, Sonia. I have all buy calls today. A couple of them large cap names and a few mid caps as well. So ICICI Bank on a mild dip, say around 875. Buy with a stop at 861. Look for targets of 900. Bajaj Finserv is a buy with a stop below 1250 for targets of 1310. Dalmia Bharat made a fresh swing high, so that's a buy as well. Keep a stop at 1940. Look for targets of 2030. And Trent is the final buy call, recommending to buy here with a stop below 1355 for targets of 1410.
Shrikant, what about you? What are your trades?
Yeah, I think a few chemical companies, they are really doing well. They are rebounding from their crucial levels. And in fact, they have spent a lot of time close to their important support levels. In that space, we like Deepak Nitrite, which is currently at 1840, 1845. From here, the stock can move to the levels of 1950 or 2000 level. So it's a buy at current levels with a stop loss at 1800. And also we like a few IT companies in that HCL Technologies, which is currently around 1085, 1090. There also we feel that the stock has completed its correction and it is relatively outperforming to the entire basket. So the stock can move to the levels of 1140 or 1150 in the near term. It's a buy at current levels around 1085 with a stop loss around 1060.
All right, Shrikant and Mitesh, thanks a lot for joining in and giving us those updates. Let's take a quick break. On the other side, we'll have the pre-opening rates. We will also have Shashank Srivastava of Maruti Suzuki to discuss their record sales that they hit in FY23. March, though, was a bit of a flat performance on the wholesale side. More on the commentary from the management, demand trends coming in just a bit.